Consumers have been urged to look after their credit record so they can have a better credit score and secure a good interest rate. If you fail to pay your creditors on time or you have too many credit commitments, you run the risk of having a bad credit record. This means that the cost of borrowing, especially for big items like a car and a house, will be too expensive.
Different credit bureaus list both the positive and negative information of more than 25 million credit active individuals. Credit bureaus use this information to determine what credit score they should give you. Each credit bureau has its own credit score, which can range from 0 to 100. Your credit score will determine what interest rate credit providers will offer you. Making too many applications for credit at the same time will also affect your credit score. But just what can a consumer do to improve their credit score?
The interest rate which the credit provider is likely to grant you is going to be dependent on the type of score which you manage to score when they ask you the various questions which have to do with your ability to pay, the amount of debt which a loan which you are looking for, how frequent are you paying your debt, are you paying on time, and all those kind of considerations.
Consumers are entitled to access a free credit report once a year from any credit bureau. When you have made late payment or no payment at all, a default will remain on your credit report for a year. Credit providers can also apply for a cost judgment against you, and it will remain on your credit report for 5 years or until you pay in full. But there have been instances where consumers had false information on the credit bureau.
The first instance is you would go to your credit provider and request, documentation or proof that, why have, they've put this record onto your credit profile. So I think that is the first step. If you're not getting any joy from a credit provider, then you come onto the credit bureau where we can assist you with facilitating that investigation.
Your credit score will determine the interest rate you are likely to get from the banks. And if you have a negative listing or judgment against your name, the chances of securing a better interest rate for your home loan or car are slim. Many low-income earners struggle to secure a good credit score from financial institutions. This is primarily because they are regarded as high-risk individuals. Paying off your accounts in full every month and settling your outstanding debt can help improve your credit score.
Latest amendment of the National Credit Act, which was passed this year, seemed to have actually made life much more difficult for the low end of the market, because the perception is that it is because they are, I won't say poor, but let's say the low end of the market, they don't have the ability to service their debt.
Your credit score won't necessarily change when you get married. But if your spouse has a bad credit history, you might be charged a higher interest rate or your application won't be approved.
When you get into a marriage, your scores don't just merge together. What happens is, if you decide to jointly purchase a property or take on a car loan, for instance, that's when your credit scores become important, because your credit provider is going to look at each of your credit reports in order to determine whether you can afford the loan amount, as well as whether you can what is your financial position, basically.
I'd like to hear your views on this topic. My email address is mulifint@sabc.co.za. My Twitter handle is @mulifinaledi.
Let's get more on this now. I'm joined in studio by Mark Wells from Experian. Thanks so much for your time on SABC News. Why are credit bureaus important, and why is knowing your credit rating important as well?
So thank you for having me. Credit bureaus are important because we're the companies that keep all of this aggregated data and represent consumers in the best possible way so that they can get access to credit. Many organizations provide credit to consumers, banks, financial services, telcos, etc. and they'll submit their data to credit bureaus so that we can build credit scores and best represent those consumers. The reason we have credit scores is we're really trying to tell a story about consumers so that they can get access to finances and make sure that their next big purchase is something that they'll be able to get money for.
Talk to us about what affects that credit score.
So many things affect the credit score, but really the primary derivative of what goes into a credit score is something called payment profile data. What payment profile data is how we as consumers pay our accounts. The credit bureau, as we heard in the previous segment, stores both positive and negative data. And so positive data would be when we as consumers pay our accounts on time, we pay at least the minimum amount, and all of those records go on to the credit bureau. In negative data, obviously, if you don't pay your accounts, or you're paying less than you should, or you're paying late, that then gets recorded as negative data. And we combine that positive and negative data to try and tell the best possible factual score about consumers.
So who can report or who can give this information to a credit bureau?
So all credit providers are obligated to submit their data to credit bureaus. So anybody that is offering any sort of credit extension or any sort of hire purchase actually submits all of their customers' data as they pay or as they don't pay to credit bureau.
What about debt collectors? And there's been a statement that people who have a lower income are more likely to have a negative credit score. Is that true?
So it isn't true, because it's really about behavior. People that earn less could still be very, very diligent in terms of how they pay their accounts. Debt collectors are really organizations that are dealing with adverse customers, and those adverse customers haven't displayed the right behavior and have negative data on the credit bureau. There are many very high earners that have bad credit scores, and low earners that have good credit scores. It's really much more driven by the behavior and how disciplined you are with paying your accounts.
What happens if you're wrongfully listed?
So it does happen, and listing is a difficult term because we don't actually list customers or consumers. What happens is they have negative data on the bureau. Sometimes that does happen. The data on the bureau is only as good as the information that is provided by those credit providers, and so consumers have every right to call the credit bureau and lodge a dispute. And the credit bureau, for free, there's no charge to it, is obligated to work with that credit provider that has given that negative information and resolve that dispute. If there's no response from the credit provider within 20 days, then the law dictates that the outcome is always in favor of the consumer.
Okay. Does your husband, wife, or partner's credit score affect yours?
The only time that happens is if you apply for joint credit. So if you're applying for a loan on your own, then absolutely not. There is no influence whatsoever from your spouse. But if you're applying, for example, for a mortgage and you want that mortgage and the loan to be in both of your names, then the mortgage provider will look at both of your credit reports and have a look at both of your credit scores, and will make a decision based on all of that information.
Mark Wells from Experian, thanks so much for your time on SABC News this afternoon, talking to us about credit bureaus. It's time for a short break.